The cryptocurrency market is brutal right now. Look in any direction and you'll see red charts. Bitcoin has ended up in the red for 8 consecutive weeks, a record for the cryptocurrency, and Ether is at its lower point since 2020. While it's painful for crypto investors, this dive isn't entirely unprecedented. Cryptocurrencies are infamous for their volatility, and tempestuous economic conditions are bringing down not just crypto, but the stock market too. What is unprecedented, however, is the collapse of the Luna cryptocurrency and its associated Tera stablecoin, aka UST. You may not have heard of UST before, or know what a stablecoin is, but it's a big deal. Billions of dollars in crypto wealth have been vaporized, sending shockwaves throughout the whole market. There are two intertwined stories here, that of the UST stablecoin and that of Luna, both of which are part of the Tera blockchain. The UST coin is designed to retain a value of $1 at all times, but it was depegged on May 9 and has since fallen to just 7 cents. Then there's Luna, the centerpiece of Tera's ecosystem. Its value has collapsed in one of the most stunning cryptos crashes ever recorded. The coin's price fell from $116 in April to a fraction of a penny at the time of writing. Such an implosion has been seen in small-cap memecoins in the past, but never for something the size of Luna, which had a market cap of over $40 billion just last month. This is historic for the crypto markets, said Mike Burrows, co-founder of crypto investments firm Fortis Digital. This is a defining moment for the space due to its size and impact in terms of the number of people that lost substantial value. The Tera saga has bigger implications than the lost billions. It's brought up questions about similar tokens, namely Tether, and regulators across the political aisle have their eyes set on stable coins. Here's what you need to know. Tera is a blockchain, just like Ethereum and Bitcoin. While Ethereum's blockchain natively produces Ether tokens, Tera natively produces Luna. In the days preceding the depeg, Luna was trading at $85. To create UST, you need to burn Luna. So for instance, in early May you could trade one Luna token for 85 UST, but the Luna would be destroyed in the process. This deflationary protocol was meant to ensure Luna's long-term growth. As more people buy into UST, more Luna would be burned, making the remaining Luna supply more valuable. To entice traders to burn Luna to create UST, creators offered an insane 19.5% yield on staking, which is essentially crypto terminology for earning 19.5% interest on a loan through what they called the anchor protocol. Instead of parking your savings at a bank for a 0.06% interest rate, the pitch is to put your money into UST, where it can earn nearly 20% in interest. Before the depegging, over 70% of UST circulating supply, around $14 billion, was deposited in this scheme. It all makes sense. But UST, at this moment worth 7 cents. It all started on Saturday, May 7. Over $2 billion worth of UST was unstacked, and hundreds of millions of it was immediately sold. Whether this was a reaction to a volatile period, the rise in interest rates has particularly affected cryptocurrency prices, or a more malicious attack on Tera's system is a topic of debate. Such huge sales pushed the price down to 91 cents. Traders tried to take advantage of arbitrage, exchanging 90 cents worth of UST for $1 worth of Luna, but then a speed bump appeared. Only $100 million worth of UST can be burned for Luna per day. Investors, already flighty in the current gloomy market, flocked to sell their UST once the stablecoin couldn't retain its peg. It bounced between 30 cents and 50 cents in the week following the initial depeg, but has now fallen to a steady low of under 20 cents. Its market cap, which was around $18 billion in early May, now stands at $770 million. This matters for 3 reasons. First, over $17 billion in crypto value has been wiped out through Luna and UST alone. There have been anecdotal reports of self-harm by those who had most of their savings staked in UST. Though these can be confirmed, it's clear that a lot of people lost a lot of money in the collapse. The damage isn't contained to Tera's ecosystem though, as Fortis Digital's Burrows notes. Many who were exposed to Luna and UST would have sold off big parts of their crypto portfolio to recoup some of the damage, pulling the entire market down. Second, it raises questions about other stablecoins. Again, UST was unusual in that it was an algorithmic stablecoin, unlike Tether and USDC. But the stability of those coins has always been somewhat in doubt. For instance, New York's Attorney General last year accused Tether, the biggest stablecoin, of lying about how much it actually held in dollar reserves. An estimated $10 billion of Tether has been withdrawn since May 11, leading some to speculate that it may be the second stablecoin to depeg. Last, and possibly most significantly, The collapse of UST has caught the attention of powerful politicians and regulators. Secretary of the Treasury Janet Yellen said on May 10 that UST's deep pegging simply illustrates that this is a rapidly growing product and there are rapidly growing risks. It's been a rough week for Tera developers since UST depegged. After some, including Binance CEO Changpeng Zhao, questioned how the project's Bitcoin reserves were used, the Luna Foundation Guard, the consortium set up to protect UST's peg, tweeted that its Bitcoin reserves fell from $2.2 billion to just $9.2 million. The remaining reserves will be used to compensate remaining users of UST, smallest holders first. Meanwhile, Quan, the Terraform Labs CEO, has a controversial plan to revive Luna. Quan proposed a plan to fork the Tera blockchain. In essence, this means the creation of a new blockchain that's modeled on the previous one, with some key changes. The new blockchain would be created alongside a billion Luna tokens, which would be distributed among current Luna and UST holders, as well as fund the development of new Tera apps. Perhaps conceding the foundational problem of tethering Luna to UST, Quan proposed removing UST, previously the main selling point of the blockchain, from the Tera ecosystem. He said, Tera's app ecosystem contains hundreds of developers working on everything from DeFi to fungible labor markets, state-of-the-art infrastructure, and community experience. The most famous fork in crypto history happened to Ethereum in 2016. After a hacker robbed 3.6 million Ether from a DAO, then worth $50 million, now worth over $7 billion. Ethereum's developers forked the blockchain, creating a new chain identical in all ways except the restoration of the stolen million Ether. It caused a rift within the community, with some maintaining the original chain to this day, calling it Ethereum Classic. Quan's plan is a nod to that fork. The new plan will see the current Tera blockchain renamed to Tera Classic, while the new chain will simply go by Tera. Many, including Zhao, are skeptical that the plan will work, but UST and Luna holders voted in favor of the proposal. A new era for Luna will begin around May 27, when Terraform Labs hopes to launch the new ecosystem. That's all for today. Hit the subscribe button and let us know what's your opinion about Tera Luna's comeback. We'll be back with freshly brewed content again. Stay tuned.